Primaris REIT beat Q2 consensus, and they did it while actively managing 22 football fields of completely dead mall space.
Yeah, that scale is just wild to think about.
Right. I mean, total rental revenue came in at $174.1 million, and funds from operations, or FFO, per diluted unit, hit a 0.451 cents, which actually edged past analysts' expectations.
And they reaffirmed all full year 2026 guidance right out of the gate.
Exactly. They are projecting FFO of $1.85 to $1.90, cash net operating income between $390 and $400 million, and an occupancy target between 86 and 88%.
So shares popped slightly on the open, but, they've settled relatively flat since then.
Yeah, the market is just trying to digest some really noisy accounting in this release. Like if you were looking at your brokerage app right now, you might see a headline showing a 1.3% year-over-year FFO growth, or, even worse, a GAAP net loss of $13.7 million.
Which is the kind of headline data that just causes immediate panic.
Oh, totally. But your app isn't giving you the underlying mechanics of what just happened this quarter. We really need to pull apart that GAAP net loss first.
We do, because it is a perfect example of how accounting rules can just completely obscure real estate performance.
Right.
That $13.7 million loss is driven almost entirely by a $68.5 million non-cash fair value adjustment. It's tied to their exchangeable preferred LP units.
Okay, because to understand this mechanism, you have to realize those LP units are treated as a liability on the balance sheet.
Exactly. So when Primaris's unit price actually goes up, or the underlying value of the enterprise strengthens, the theoretical cost to settle that liability increases.
Right, so GAAP accounting forces the company to report that increase in the liability's value as a daily financial loss.
Yeah.
It's essentially like being forced to appraise your house every single day, right? And because the housing market went up, your mortgage technically got more valuable to the bank.
Right, which sounds good for the bank.
But you are forced to report a massive cash loss on your personal tax return, even though no money actually left your wallet. It completely distorts the operational cash flow.
That is the exact mechanism at play here. It has absolutely zero bearing on the cash the properties are actually generating.
So it's basically paper losses.
Exactly. To find the true operational baseline of the portfolio, we have to look past the GAAP distortions and past that unadjusted 1.3% FFO growth. We need to focus on the normalized FFO growth.
Which is actually positive 5.4%.
Yes. But getting to that 5.4% engine requires stripping out two specific operational anomalies from the comparison.
Okay, what are they?
First, management recorded $1.9 million in terminated transaction costs in 2026. Basically, deal fees for acquisitions that just didn't materialize.
Got it. And the second?
Second, there's a new $1.4 million variance from prior year property tax recoveries. Last year, they successfully appealed some municipal property taxes and got a lump sum refund, which obviously pumped up the 2025 numbers.
It's like looking through a dirty windshield, Once you wipe away the one-time deal fees and the municipal tax refund noise and that bizarre accounting loop with the LP units, you see what's really happening.
The view gets a lot clearer.
Yeah, the actual cash engine of the properties is running significantly hotter than the headline suggests. That positive 5.4% normalized FFO growth, that is the metric that tells you the malls are fundamentally performing.
Which brings us directly to the property level cash flows, because leasing metrics are the literal fuel for that 5.4% engine.
Right, so let's look at those. Same properties cash net operating income grew 0.5% or 1.1% if we adjust for that property tax noise you mentioned.
Right.
But it's the volume of deal flow that really stands out to me. The REIT executed 141 commercial retail unit or CRU deals across 287,000 square feet.
That is a lot of ink drying.
Yeah, and the average net rent locked in on those deals was $56.30 per square foot. And the metric that signals actual leverage over the tenants, the renewing net rents, saw a solid positive 7.4% spread.
See, pushing a 7.4% rent increase across 482,000 square feet of renewals, especially in this specific macroeconomic environment, is just a massive indicator of pricing power.
How so?
Well, think about it. When a retailer's lease expires, they do the math on relocating. Moving a store involves heavy capital expenditures. You need new fixtures, new signage, you have to retrain staff, and you lose all your established foot traffic.
Right, it's not cheap to just pack up a store.
Exactly. But tenants will absolutely incur those costs and leave if the mall is dying.
True.
Agreeing to a 7% bump means the tenants are looking at their own sales data and deciding the foot traffic at a Primaris property is simply too valuable to abandon.
And the productivity metrics back this up entirely, right?
Hmm.
Same-store sales productivity climbed to $825 per square foot.
Which is a very healthy number.
That $825 per square foot number is critical for anyone trying to evaluate the health of enclosed shopping centers. If a tenant is generating over $800 for every square foot of space they rent, paying $56 in net rent is highly affordable.
Yeah, their occupancy cost ratio remains incredibly healthy there.
But the REIT also has to protect its own margins against inflation, which they actually seem to be doing pretty efficiently.
Yeah, the combined operating cost recovery ratio held steady at 80.1%, which proves that efficiency.
Okay, unpack that recovery ratio for us.
Well, running a massive enclosed mall involves heavy escalating costs. Think about commercial HVAC maintenance, 247 security, massive utility bills for common areas, snow removal for acres of parking.
It's basically a small city.
Right. So a recovery ratio of 80.1% means that for every dollar Primaris spends on those operating expenses, the tenants are contractually obligated to reimburse them roughly 80 cents.
Wow, okay, so the tenants absorb the vast majority of the inflationary pressure through their lease structures.
Exactly.
I want to dig into a very specific discrepancy in the occupancy data here because I think it points to where this revenue is heading next quarter.
Oh, the committed versus in-place gap?
Yes, management reported a 91.1% committed occupancy, but only an 86.6% in-place occupancy. That 4.5% spread isn't just a rounding error. Across a portfolio of this size, it represents a massive amount of square footage.
It really does.
Can you walk us through the mechanics of that gap?
Honestly, it is arguably the most bullish embedded metric in the entire report because it represents guaranteed, legally contracted growth.
Okay, how so?
Well, in-place occupancy strictly measures tenants who have the keys, they have their doors open, and they are actively paying cash rent today.
Right?
But committed occupancy includes tenants who have signed binding leases but haven't taken possession yet. The lawyers have finished, the ink is dry. But the physical reality of commercial real estate involves a lot of friction.
Like what kind of friction?
The tenant might be waiting for the REIT to finish pouring a new concrete floor, or maybe they're waiting on a municipal building inspector to issue a certificate of occupancy, or they just have a staggered move-in date set for Q3.
Ah, I see. So that 4.5% gap is essentially locked-in margin expansion just waiting in the wings.
Exactly.
It provides management and retail investors incredible visibility into the near-term revenue trajectory. The revenue is already captured, it just hasn't hit the income statement yet.
Right.
But, that 4.5% gap isn't just a random assortment of small boutiques taking their time moving in. The vast majority of that future revenue is tied to one massive specific ghost in the retail machine.
Hudson's Bay Company.
Yes, the footprint left by HBC.
The legacy anchor tenant problem. It is the defining challenge for almost every major mall operator in the country right now.
And the scale here is staggering. Primaris has full control of 1.3 million square feet of former HBC space across their portfolio. As I mentioned at the top of the deep dive, that is 22 football fields of prime retail real estate.
It's massive.
Currently, they are reporting that 84% of this space is either leased or in advanced negotiations.
With 58% already under long-term binding leases, which is key.
Yeah, but here is the number that absolutely jumps off the page for me. These new leases are expected to generate $14.9 million in annual rental revenue. That is exactly 4 times the rent previously generated when that exact same space was occupied by a single HBC department store.
4 times the rent. It really illustrates a fundamental shift in retail real estate thermodynamics.
How do you mean?
Well, historically, mall operators relied on massive department stores like HBC to act as the gravitational pull for the entire property. The REIT would give them 100,000 square feet for practically nothing, maybe $2 or $3 a square foot, because the department store was the magnet that drew the thousands of daily shoppers.
Right, and then the mall would subsidize that loss by charging high rents to the smaller inline stores that fed off that foot traffic.
Exactly. Furthermore, those old anchor leases were loaded with restrictive covenants. The anchor could dictate mall hours, block certain competitors from opening, and even veto changes to the parking lot.
So not only were they paying pennies on the dollar, but they were legally handcuffing the landlord.
Exactly.
And then consumer behavior shifted, foot traffic to legacy department stores plummeted, and the anchor went from being the mall's engine to being a parasitic deadweight.
Precisely the issue management faced here. And their strategy to fix it is really twofold. First, they completely abandoned the old model. They aren't hunting for another massive single-tenant anchor to swallow the whole box and bargain basement prices. Instead, they are intentionally repurposing and subdividing the spaces.
So they're breaking them down.
Right, they're physically carving up a 100,000 square foot box to accommodate 4 or 5 large-format, high-value tenants.
And the second part of the strategy.
Well, the physical reality of subdividing takes a lot of time. You have to secure municipal permits, design new facades, reroute utilities. So while those complex planning activities are finalized for the permanent carve-ups, Primaris is executing short-term leases with reputable tenants to restore immediate rental income.
Ah, clever. Keeping the lights on and cash flowing while they build the permanent solution.
Exactly.
You know, it's essentially a real estate version of a highly accretive stock split.
I like that analogy.
Right. You take one giant, heavy, low-yielding asset and deliberately carve it up into a fleet of agile, high-paying retailers. You dramatically increase the yield per square foot. Taking the rent from a rounding error up to $14.9 million is a masterclass in value creation.
It really is.
But actually executing that subdivision has to be incredibly complex.
Oh, it is extremely capital and labor intensive. Moving demising walls is just the start of it.
What else goes into it?
Well, an old HBC store had a centralized HVAC system and a single massive electrical panel. If you carve that into 5 separate stores, you need 5 separate HVAC roof units, 5 separate electrical meters, completely redesigned fire suppression zones.
Right, the infrastructure has to multiply.
Yeah, and often you have to cut into the exterior walls to build outward-facing entrances so these new tenants don't have to rely on interior mall hours.
Wow.
Doing this efficiently requires a vertically integrated management team. Because if you outsource all of that development and project management, your capital expenditures will completely destroy the yield on that new $14.9 million in rent.
Yeah, you cannot carve up 22 football fields for free. Which leads us directly into the balance sheet and their recent capital allocation decisions.
Right.
Management noted approximately $35 million in redevelopment capital expenditures, specifically attributable to these vacant HBC anchor spaces just for 2026.
Which is a massive chunk of their total redevelopment CapEx budget of $60 to $64 million.
So funding that outlay requires careful balance sheet management. They currently hold a robust liquidity position of $655.1 million, backed by $4.9 billion in unencumbered assets.
And that unencumbered metric is absolutely vital here. It means the vast majority of their properties do not have individual property-level mortgages tied to them, which provides enormous financial flexibility.
And they have been aggressively recycling capital to fund these moves without blowing up their leverage. Let's look at the transactions on both sides of the ledger.
Okay.
On the disposition side, they closed on $99.5 million in non-core shopping centers on June 1st. So they are trimming the fat, selling off smaller or less efficient properties.
Right.
Then they strategically deployed that capital. They spent $64 million to acquire the remaining 50% interest in Regent Mall in New Brunswick, taking full control of a high-performing asset.
Smart move.
Yeah. They also bought an adjoining vacant HBC box at Devonshire Mall in Ontario for $4.5 million. But alongside these property deals, they have been heavily active in their normal course issuer bid, their share buyback program.
Right, the NCIB.
Primaris purchased 165,700 units at an average price of $18.44. Now, that is a 15.1% discount to their Q2 net asset value of $21.72.
See, buying $1 of real estate for 85 cents through share buybacks is an immediate, risk-free return on capital for the remaining unit holders.
Sure, on paper.
However, we have to look at this through the lens of their leverage. Their average net debt to adjusted EBITDA sits exactly at 6.0x.
And I am going to push back hard on management's capital allocation strategy right here, because sitting exactly at 6.0x leverage is a red flag when you look at their own internal guardrails.
I think so.
Absolutely. The REIT has an explicitly stated target for net debt to adjusted EBITDA of 4.0x to 6.0x. They are currently touching the absolute ceiling of their own leverage targets.
Right. They are at the top end.
So if you are at your self-imposed debt ceiling and you have a non-negotiable $60 to $64 million in critical redevelopment CapEx coming due just to get these HBC boxes online, is diverting cash to buy back units at a 15% discount actually the optimal move?
It's a fair question.
Shouldn't they be hoarding cash or paying down debt to give themselves a buffer?
Well, management's defense against that exact critique relies entirely on the composition of their balance sheet.
Mhm.
specifically that $4.9 billion pool of unencumbered assets we talked about.
Okay, how does that save them?
They argue that if the credit markets freeze or if the macro environment deteriorates, they do not face a wall of property-level mortgages coming due that they might fail to refinance.
Okay.
If they absolutely need cash to finish the HBC redevelopment, they have the legal flexibility to place new debt on those unencumbered assets. They believe the unencumbered pool makes the 6.0x ratio significantly safer than a typical heavily mortgaged REIT. It allows them the breathing room to exploit the public market's mispricing of their stock.
Yeah, but I'm just not buying that unencumbered asset defense in this specific macroeconomic environment.
Really?
Yes, they have $4.9 billion in unencumbered properties they could technically mortgage, but look at interest rates.
Well, rates are tricky right now.
Right. If you are forced to place new debt on an unencumbered mall in 2026, you are going to eat a massive interest rate penalty compared to historical debt costs. You are essentially trading a temporary liquidity solution for a permanent interest expense problem.
Borrowing against those assets right now would completely destroy the cash flow yield they're trying to build with the HBC redevelopment. And that is the genuine tension in the model. If you borrow at elevated rates to fund capital expenditures, your interest expense eats the NOI growth you just built. It is a calculated risk by management.
A big risk.
They are betting that their internal cash flow generation, combined with their capital recycling program, selling non-core assets to fund the core, will be enough to thread the needle without having to tap that unencumbered pool at punitive interest rates.
But operating at the 6.0x ceiling leaves them with very little margin for error if the macro environment shifts unexpectedly.
That's true.
And that lack of a safety buffer forces us to read the fine print on the forward-looking risks they explicitly flagged in the report. Because you cannot take a victory lap on multiplying rent by 4 without acknowledging how delicate the execution actually is.
So true.
Let's look closely at the caveats tied to that $14.9 million in anticipated HBC rent. Management openly noted that a significant portion of that future revenue relies on leases that are only in, quote, advanced discussions. The ink is not dry. If consumer spending cools or a specific retail sector hits a headwind, advanced discussions can turn into dead deals overnight, leaving Primaris holding an empty box and a massive capex bill.
And the execution risk is exactly why management had to adjust their forward-looking 3-year targets, which run through 2027.
Oh, right. They revised those.
Yeah. In this report, they explicitly noted that they reduced their in-place occupancy target from a firm 96% down to a range of 94 to 96%.
Which is a pretty significant step down for a long-term target.
It is. They had to lower expectations, specifically because of the drag created by the HBC exposure and their recent acquisition activity. Taking control of these empty boxes, while highly accretive in the long run, actively hurts their current operating metrics.
Right.
It is a drag on current yield in exchange for future growth. But as you pointed out, that future growth requires flawless execution.
Which brings us to the biggest execution risk on the board, the land monetization strategy.
Oh, this is a big one.
To help manage the balance sheet, fund the HBC carve-ups, and keep that debt ceiling in check without borrowing at high rates, the company has identified $275 to $375 million in excess land for potential monetization.
We are talking about roughly 120 acres of peripheral mall land or excess parking lots.
Honestly, I severely question the viability of unlocking over $300 million in the current lending environment.
Monetizing excess retail land is incredibly complex, even in a bull market.
Right.
You aren't just putting a for sale sign on a parking lot. You have to legally sever the parcels from the main mall footprint, which triggers all sorts of municipal zoning reviews.
You can imagine the red tape.
Oh, it's endless. You often have to perform environmental assessments on asphalt that has been catching motor oil for 40 years. And then, after all that, you have to actually find a buyer.
And who usually buys that kind of land?
Typically, the buyers for this peripheral land are residential developers looking to build mid-rise condos or apartments.
And residential developers are highly sensitive to interest rates and construction costs right now.
Extremely.
If a developer cannot secure financing to build a condo tower because lenders are tightening their belts, they aren't going to buy 120 acres of parking lot from Primaris. So if that land sits idle, what happens to the balance sheet?
Well, land is a non-income producing asset. It generates zero net operating income. In fact, it's a negative drag on cash flow because you are still paying property taxes and maintenance on it while you wait for a buyer.
Yikes.
If the land market freezes and they cannot monetize that $270 to $375 million on their expected timeline, the pressure on their capital allocation intensifies dramatically.
That goes back to the debt ceiling.
Exactly. Remember the 6.0 debt ceiling we debated? Selling that land is one of their primary levers for paying down debt and funding the HBC redevelopment without breaching their leverage targets.
So if they can't pull that lever,
If they can't pull it, they have to rely entirely on property-level cash flow or they have to start tapping the unencumbered asset pool at exactly the high interest rates they want to avoid. It significantly reduces their operational runway.
it forces them to be absolutely perfect on the leasing execution of the HBC carve-ups. If the land doesn't sell, they literally cannot afford for those advanced discussions to fall through. Every single subdivided box has to convert into a paying tenant right on schedule.
It's a tightrope walk for sure.
It really is. So what does this entire earnings report mean for you, the listener, trying to make sense of your portfolio and the broader retail real estate landscape? Here is a final thought to mull over.
Let's hear it.
The physical evolution of the HBC spaces in the Primaris portfolio proves a vital reality. Legacy department store closures are not the death knell for retail real estate that the headlines always claim. They are a mispriced opportunity, provided the landlord has the capital and the operational skill to execute.
It requires a fundamental shift in how investors evaluate mall operators. The empty 100,000 square foot box is no longer the liability. The lack of proactive redevelopment strategy is the liability.
Exactly. We just saw a management team take millions of square feet of dead space and map out a credible, albeit highly complex, plan to quadruple the rent.
Quadruple it.
Apply this lens to the other retail REITs you follow. Look past their headline occupancy drops. Are the management teams you are invested in proactively taking a sledgehammer to their dead anchor spaces to multiply their yield?
Or are they just letting them sit empty?
Right. Are they paralyzed by the CapEx requirements, waiting for a miracle department store tenant that simply doesn't exist anymore? That is the dividing line between a value trap and a value creation engine.
It's the ultimate test for these operators right now.
Make sure you follow the show for daily, no-fluff earnings coverage just like this deep dive. We will see you tomorrow.